Hi, Greg here from More Than Accountants. So something I want to have a chat about today was in relation to, I guess, what's going on at the moment with COVID and the Zoom revolution. And there's a little bit of potential there in terms of, I guess, a potential trend emerging where people are potentially looking at buying into holiday, holiday or lifestyle destinations. So what I want to do is have a little bit of a look at that and step through some of the considerations and factors that you need to weigh up before sort of jumping into that type of investment. So we'll have a bit of a step through that. Yeah, so firstly, talking about holiday destinations, this is actually a pick from a trip I recently had. So we just got back recently from the Whitsundays. So this is a shot looking out over Whitehaven Beach, pretty spectacular as you can see. Be pretty happy to live there. And I guess when you go to these type of destinations, that's where I can understand where people start thinking about, hey, they're holidaying in those places. Could it be a good place to invest? Maybe there's an opportunity to basically have your cake and eat it too, in terms of having somewhere where you could actually holiday yourself, but also have an investment and maybe get some of those tax advantages that come along with it. You could also be looking further down the track that that potential location might be your future retirement location as well. So it's a way of getting into that market now. Potentially before prices are higher in the future, that you can get in there when it's affordable to do so. And also, with some of these type of properties, particularly when you look at the rents that are achieved during some of the peak periods, those yields can look pretty appealing, and therefore, it might sort of, at least on surface level, stack up as a pretty good investment. But I guess there are a couple of key points to consider in that. And the first one, particularly if you are using it as holiday letting, is the income can be seasonal and it can be inconsistent. So obviously there's peaks and troughs throughout that. You might actually, in the good times, when things are in those peak periods, you potentially can get pretty high rents, good income coming in. But obviously there's also periods where there's potential downsides there, or downturns there, or low periods. And it could be the case that you might go for a week or two or even longer, or days without a tenant in there at all. So there's a potential upside and downside. So when it's going well, it can be going really well, but when it's not going so well, then you can actually struggle for income to come through. The other thing is in terms of the higher operational costs that can come with that type of property. So yes, you can get good rent in, but then there's a lot of servicing costs associated with that, in terms of every time someone sort of moves in and moves out, you've got to get the property cleaned. You've got management fees, which are going to be high because every time you're trying to relet the property, so managers are going to charge much higher fees to do that, because they've got to continue to market and find new tenants for that property all the time. And then you've obviously got to meet the other costs that are associated with that. So someone's coming in there paying higher rent, but then you've got to cover their power, their water costs, etc. So you might be getting a higher rental income coming in, but then there can be a lot of things coming off that you need to actually manage as well. And the thing is, even when it's not tenanted, you are still paying out management fees for that manager to basically advertise and market that property for you. So potentially there's going to be costs going out even if there's no rent coming in during those periods. The other thing, obviously, if you're doing holiday letting, is you've got to look at basically furnishing that property. You've got to cover breakages as well. So that means that you've got to keep, you've got to bring additional plant and equipment into that property as well. So yes, you can get some deductions on that, but you equally got to put your hand in your pocket to go spend that money up front as well. If you do want to use that property for personal use, so, think about it, like, when are the times that you're going to want to use it? It's potentially around those peak periods. So, if you want a holiday there over Christmas, that's fine. You've got a place for Christmas, but you're potentially missing out on the highest income that you could earn in that period. So you could actually be giving up your peak income period. And the other thing is, if you're using that property for personal use for those periods, you're going to miss out on any tax deductions that go along with that. So personal use, you can't claim during those periods. So you're potentially giving up some tax benefits as well. So they're sort of, you know, on an income side of things, they're the other things you've got to think about. And then depending on the type of building you're in, so I'm talking about units, you know, there's potentially some fairly high body corporates in some of these, you know, particularly high-rise units where they've got fairly high servicing costs in terms of, you know, managing pools, elevators, all those sort of things, and then also, you know, looking to have to repaint buildings over time, all those sort of factors as well. So you can find that some of the body corps in those areas, you know, in those sort of properties can be quite high as well. I guess that one of the main things you've got to think about also in buying into those sort of markets is they can be vulnerable to economic downturns. So those sort of, you know, a lot of those sort of lifestyle holiday destinations, when things are going well, those markets can tend to go really well. So, you know, obviously when people are feeling confident, they've got plenty of cash, or they've got good equity in their homes, then, you know, that's when they might look at buying into those sort of markets. And those markets are generally supported by people who don't necessarily live there on a permanent basis, but are buying from outside. But of course, when the economy gets tough, things go backwards. You know, what happens? People want to get out of those markets. They want to try and sell their you know, holiday unit. But also, you know, if everyone's in the same boat trying to do the same thing at the same time, then you potentially got sort of risk there where everyone's trying to get out of that market at the same time. And you can often see that sort of prices fall away and potentially rents also fall away. The other thing with those type of markets is you can often find that they can also be a bit vulnerable to oversupply risk. So you tend to find when those markets are going well, that tends to be when developers will come into those markets. They'll actually, you know, build more units and add more stock to the market as well, which, you know, can sort of get picked up pretty quickly when things are going well. But what that also means is there could be a lot of excess stock on those in that market, again, if you end up with that downturn. So it means, again, a lot of people who aren't living and working in that area are buying into those markets, but the people who live and work there aren't necessarily buying in. So it's supported from basically, you know, external buyers, but not by local market. And the bottom line is, when things go bad, the external buyers pull out. There's not enough demand there from the local market to prop those prices up, and you can often find they fall away a little bit. And, you know, like, this is just a couple of examples. So, you know, I'm not saying this applies to every single market everywhere, but, you know, if we look at a couple of sort of holiday locations on the Gold Coast, like Broadbeach, what we can sort of see is obviously, you know, the market went well when the market was booming, and that's done well. But since that time, you know, pretty much if you had a sort of board here around about the peak, you pretty much haven't recovered your position at this point. And as you can also see, the market sort of had a few ups and downs during that period. So you tend to get a little bit of volatility. And often what you find is those spikes in the market are often driven by new development coming into that market. So that sort of pushes the price along a little bit. But then, you know, if things go a little bit sour, then the market tends to fall away. So you tend to sort of see this, you know, a bit of a roller coaster ride in these sort of markets as well. Again, having a look at Surfers Paradise, pretty similar sort of picture. You know, again, these are areas that have got a fair bit of density in terms of unit development, and you tend to see this same sort of pattern emerging, where there's a lot of peaks and troughs sort of happening in that market. But, you know, generally, I guess other than when we had this nice boom back in the early 2000s, you know, there hasn't been a lot of real growth in those markets. The other things you've got to think about as well is that particularly holiday type accommodation is not strongly favoured by a lot of the banks and lenders. So some of them won't actually touch certain property types at all. Or the other thing that you could find is You generally can be subject to higher income shading. So what that means is the rental income that you're getting off that property, if you're looking at it from a loan servicing point of view, can be discounted more heavily, which therefore means that your servicing or borrowing capacity is going to be reduced in terms of how much debt you can service based on how the banks would look at it. And also the other thing is that it can often be more restrictive in terms of how much a bank is prepared to lend against that property. So, they might only go to 60% of that property's value, for example, which therefore means that, even if you get growth out of that property, there's not a lot of equity you're going to be able to tap into. Can be quite restricted, but it also means in the first instance you might have to come up with a much bigger chunk of capital to even buy into that market, which means you're tying up then a lot of your capital in one property, whereas opposed to, if you think about typically most other properties that banks would look at from an investment point of view, they'll generally go up to 90%. So, you might have to find an extra 30% on top of what you typically have to do if you were looking at something that the banks were more favourable. So that's just some other factors to think about. Anyway, hopefully that gives you a few things to think about in terms of you looking into those type of markets. As always, if you want to sort of support the channel, it'd be great if you could hit that like button and also click subscribe so that you'll get updated on any feeds. And also, if you want to sort of book a call and talk about your investment plans, particularly if you're looking at strategies on how to pay off your home sooner, then you can click on the link below and that'll actually take you through to my calendar and you can book a time in my schedule. Anyway, I hope you found the information of use and have a great day.